Hello, I'm Ken Carpenter, and this is Invest AI Savvy, where AI powers smart investing. Welcome to Monday, May 4th, 2026. The market is currently trapped in a dangerous catch 22. Stocks are staying buoyant largely because consumer spending is defying war gloom, yet that spending is increasingly fueled by the very stock market gains it supports. It's a cycle of faith, specifically faith in one sector, AI infrastructure. While our BuzzPulse system continues to track specific technical setups, the real story today is the K-shaped reality beneath the surface. Business investment in AI is the strongest it has been in 3 years, yet the rest of the economy is shivering. If that AI pot of gold at the end of the rainbow doesn't materialize, the floor beneath your portfolio might be thinner than you think. Today, we're zooming out. I'm breaking down the shop till AI drops phenomenon, why the US consumer is spending money that they aren't actually earning, the massive tariff threat hitting European automakers today, and why the Strait of Hormuz plan is keeping oil prices on a slow boil. We are also going to look at why our system is flagging institutional positioning in names like Palantir and Mara Holdings as they move into a heavy earnings week. Stick around because while the macro looks heavy, we found the spots where the smart money is quietly betting against the gloom. The Wall Street Journal is highlighting a fascinating divergence this morning that every retail trader needs to understand. We're currently seeing a 74-year low in consumer sentiment, yet the cash registers keep ringing. Why is there such a massive gap between how people feel and how they act? The latest data shows that personal savings rates have plummeted to 3.6%, a level not seen since the peak of the 2022 inflation crisis. For comparison, in the last 10 years leading up to the pandemic, Americans saved an average of 6.2% of their income. We've moved from a period of stimulus fueled splurging into a period where the American consumer is effectively running on empty, yet refusing to stop. There are two primary explanations for why household spending has stayed so strong relative to wage income. The first was a temporary crutch, lower tax withholding and bigger refunds for lower and middle income households, but that's a crutch that is now fading. The second reason mainly helps wealthier families, and that is stock market strength. The S&P 500 recovered its initial war losses in just 6 weeks and is now up 5% since the start of the hostilities. This highlights the catch 22. Stocks are buoyant because consumption has defied war gloom, and consumption is high because stock gains make people feel wealthy. This is the wealth effect in action. It's a psychological phenomenon where people spend more money because they see their portfolios going up, even if their actual take-home pay hasn't changed. Right now, the entire economy is essentially riding on the back of one hot sector, AI investment. While households are spending, businesses are doing their part too, but it's strictly K-shaped. Spending on AI infrastructure drove a sharp rise in business investment during the first quarter, the strongest in almost 3 years, while almost every other sector of the economy remained weak. Investors are looking at the four AI hyperscalers for hints of a slowdown, but so far, the hyperscalers haven't blinked. Even a report that OpenAI has failed to meet some internal targets only sent a brief flutter through the market. Most of these big tech companies have the financial firepower to keep investing, but if it looks like there isn't going to be a pot of gold at the end of the AI rainbow, shareholder and lender confidence could dent very quickly. Consumption is rarely dependent this much on faith in one sector and vice versa. Beyond the AI bubble, we're seeing real world friction in the form of trade wars and energy security. President Trump announced that the U.S. will guide stranded ships through the Strait of Hormuz, but without military escorts. This hasn't exactly calmed the energy markets. Oil prices are inching higher, with crude currently sitting at 102 or $102.39 a barrel. At the same time, we're seeing the return of aggressive tariffs. The US is raising tariffs on automobiles from the European Union to 25% from 15%. Shares in Mercedes Benz, BMW, and Porsche are sliding today as a result. We're moving from a period of globalized free trade into a period of protected markets, and that adds a layer of inflation that the market hasn't fully priced in. Before I name the watch list, the standard reminder: BuzzPulse is a research platform. I'm not your financial advisor, and nothing in this show is investment advice. The names you're about to hear are names the system flagged today through our proprietary scoring. They're not buy recommendations, so please do your own homework, always. Number one on our radar today is Palantir Technologies. They're due to post results after the close today, and this is the ultimate litmus test for the Wall Street Journal's AI infrastructure thesis. Palantir sits at the intersection of government spending and enterprise AI. If they show a slowdown in customer acquisition or a tightening of enterprise budgets, it could be the first real crack in the AI fake narrative. Our system is watching for the reaction in after-hours trading to see if the wealth effect can survive a potential miss from a core AI player. Number two is eBay. Shares surged 9% pre-market after GameStop CEO Ryan Cohen made an unsolicited $56 billion offer to buy the e-commerce giant. This is a massive M&A move that has taken the market by surprise. While GameStop shares slipped on the news, eBay is catching all the social momentum. This is a classic event-driven setup where the social buzz is being confirmed by massive price action. Now, number three is Tyson Foods. They report earnings before the market opens, and this is our direct window into the American consumer resilience that the Journal mentioned today. Tyson provides the staples. If Tyson shows that the consumers are finally trading down or cutting back on volume, it confirms that the low personal savings rate is finally hitting a wall. Watch the guidance here. If the consumer giants start sounding the alarm, the K-shaped economy is about to get a lot more painful for the bottom half of the K. Now, number four is Mara Holdings. Mara remains our system-defined signal of the day with a Z-score of 5.6 and a convergence depth of 10 independent signals. The stock is showing a massive 35% short interest, which is a textbook setup for a short squeeze if the narrative shifts. With earnings in just 3 days on May 7th and Bitcoin dominance rising to 58.1%, Mara is the primary asset to watch for an escalation in social momentum. Options are currently cheap with an IV rank of only 4%, meaning the market isn't yet pricing in the explosive potential our system is seeing. We also have to talk about DJT, which surfaces this morning with a greed score of 0.459 and a momentum confirmed. It reports earnings in 4 days, and like Mara, its IV rank is at 0%. When you see a 0% IV rank, it means options are as cheap as they have been historically. Someone is positioning here ahead of the earnings binary, and they're doing it while the insurance is cheap. It's a divergence that suggests a quiet accumulation before a potential loud move. Now, here's what we're skipping today. Our Greed 5 includes several names that we're treating as surveillance only. Specifically, we're avoiding the OTC names like AGPU and ETHE. AGPU is printing a massive Z-score of 12.3%, but its legitimacy score is a rock bottom 20 out of 100. That's a textbook pump profile.